The Little Book That Still Beats the Market by Joel Greenblatt presents a concise, accessible guide to a systematic, long-term investment strategy called the Magic Formula. The book is designed to provide individual investors with a simple, repeatable approach that has the potential to outperform the broader market over time. Greenblatt's strategy focuses on buying good companies at bargain prices and holding them for the long term. The Magic Formula. The core of Greenblatt's approach is the Magic Formula, which combines two key financial metrics. 1. Earnings yield. This is the inverse of the price-to-earnings (PE) ratio and represents the profit generated by a company relative to its market value. A higher earnings yield indicates that a company is generating more earnings for each dollar invested, signaling an undervalued stock. 2. Return on capital (ROC). This measures a company's ability to generate profits from its capital. A high return on capital indicates that the company is effectively using its resources to produce earnings, which is a sign of a high-quality business. Greenblatt's formula ranks companies based on these two factors, selecting those that are both undervalued, high earnings yield, and have a strong competitive advantage, high return on capital. The idea is to invest in companies that are doing well operationally, high ROC, but whose stock prices are lower than they should be, high earnings yield, providing a margin of safety and the potential for strong returns. The formula in practice Greenblatt suggests that investors should apply the Magic Formula by creating a portfolio of approximately 20 to 30 stocks from different sectors, all ranked based on their earnings yield and return on capital. The stocks are then bought and held for about a year before rebalancing the portfolio. He stresses that the strategy requires patience, as the Magic Formula approach works over time, not in short bursts. Over a long investment horizon, the strategy has been shown to consistently outperform the market, though individual years may involve periods of underperformance. Simple yet effective. Greenblatt's approach stands out for its simplicity and focus on two key factors that have a proven track record of predicting long-term investment success. By focusing on fundamentally sound businesses that are undervalued, investors can build a portfolio that has both the potential for capital appreciation and risk reduction. This approach relies on the assumption that over time, the market will recognize the intrinsic value of these companies, leading to price appreciation. Discipline and patience. One of the key lessons Greenblatt emphasizes is the importance of discipline and patience. While the Magic Formula may not always deliver immediate results or outperform the market in the short term, following the strategy consistently over many years has historically led to superior returns. Greenblatt urges investors to stay the course and avoid reacting to short-term market fluctuations, which can tempt investors to abandon the strategy at the wrong time. The role of psychology. Greenblatt also addresses the psychological aspect of investing. He notes that the strategy may lead to periods of underperformance, and during these times, investors must resist the temptation to